Welcome to the Trade Advisory Network channel. I'm John Bougea, co-founder and managing director of Trade Advisory Network. On this channel we will be publishing a series of short, free, educational videos on topical subjects concerning trade and supply chain finance. In this series we'll be focusing on URDTT, that's the Uniform Rules for Digital Trade Transactions, which was published by the ICC this year in October 2021. This series will comprise of 6 episodes, and this is episode 1. This series is made in association with ITFA, that's the International Trade and Forfeiting Association, and LIBF, that's the London Institute of Banking and Finance. ITFA have been very active in the promotion of the digitisation agenda generally, specifically with regard to the digitisation of negotiable instruments such as bills of exchange and promissory notes. In addition, they've been actively supporting the adoption of legal changes which are compliant with UNCITRAL's MLETR, that's the Model Law on Electronic Transferable Records. I'll talk about MLETR a little bit later on. LIBF is the preeminent educational body for the banking industry and is responsible for the globally recognised banking qualifications. We've had a long association with LIBF, having been the authors of the content of their certificate in supply chain finance professional qualification. For those of you that don't know us, we are Trade Advisory Network. This company was founded by 2 recovering bankers, that's myself and my colleague Lionel Taylor, back in 2014. We are specialists in trade and supply chain finance, and we work with banks, non-bank financial institutions, fintechs, technology service companies, educational bodies, investors and corporates, and also development banks. And we also provide expert witness services where required for tribunals and court cases. If, having viewed our free educational videos, you feel that your organisation would benefit from direct engagement with Trade Advisory Network, then please drop me an email or take a look at our website, details of which are on the screen. So, I think the place to start really is to ask the question, why did we decide to focus on URDTT for this first series of videos? As one of the authors of URDTT, it became apparent to me very early on in the process that these rules were conceptually quite different from other rules published by the ICC over the years. And there are a number of reasons for this difference. The first reason, I think, is that URDTT does not focus on a product. So unlike UCP, for example, which very clearly focuses on letters of credit, and URC, which focuses on collections and so on, URDTT doesn't. URDTT is something different. I'll explain what URDTT is in a second. Another reason why URDTT is quite different from other ICC publications is that it's not bank-centric. The principal parties to a trade transaction are the seller and the buyer, and URDTT is actually based on that principle. The banks clearly do have a role to play, so they're very much included in the rules, but the rules do not revolve around their input, they revolve around the activities of the seller and the buyer. Thirdly, the rules relate to processes which exist solely in a digital environment. So with URDTT there is no paper option. As a drafting group, we knew that getting the rules agreed and published was going to be a major challenge, but it's only the first step. In reality, getting the rules, once published, adopted and used to support digital trade transactions is now an even bigger challenge. So this series of videos is really an attempt to support that commercialization process. As I said, this is episode 1, and in this episode we're going to focus on the scope of URDTT and talk about its purpose and explain some of the drafting principles that went behind the drafting exercise. I'll also provide an overview of some of the key definitions, the key terminologies, such as digital trade transaction and electronic record, both of which are fundamental to an understanding of URDTT. Subsequent episodes will cover a variety of topics. So episode 2 will look at the positioning of URDTT relative to ITFA's DNI initiative, that's the Digital Negotiable Instruments initiative, and also relative to UNCITRAL's MLETR, Model Law on Electronic Transferable Records, which I've mentioned a couple of times already and will explain in a later episode. Episode 3 will look at the parties to a digital trade transaction. So I've already mentioned that the two principal parties are the seller and the buyer. The banks and the non-bank financial services providers are parties as well, but there are other parties that can be involved in a trade transaction, and they're all covered by URDTT. Episode 4 will focus on electronic records. I will touch on electronic records here today in this episode, but only at a pretty high level. When we get to episode 4, I'll go into much greater depth on the rules relating to the use of electronic records. Episode 5 will focus on payment obligations. And in this context, we're talking about corporate payment obligations. I will also talk in that episode about how banks and non-bank financial institutions can add their undertaking to a corporate payment obligation. Finally, episode 6 will look at some practical implementation considerations in the context of an overall digitization strategy. So let me start with the genesis of URDTT. The drafting group was first assembled by the ICC Banking Commission in June 2018. And the original mandate was actually to update URBPO, that's Uniform Rules for Bank Payment Obligations. Once we started looking at URBPO and the changes that would be required, we quickly came to the conclusion that we should actually start with a clean sheet of paper and write the rules from scratch. So I think I should just mention some of the issues that we uncovered with URBPO and the reasons why we decided not to try and amend URBPO but to start afresh. I think the first issue with URBPO was that it was written purely from the perspective of banks. So the only parties to a transaction which were actually governed by the rules were the banks. The seller and the buyer, who clearly are fundamental to an international trade transaction, were not included in the rules as parties. They were mentioned in the rules for sure, but they were not subject to the rules. And I think this was a major problem, causing a lack of interest from the banking community and a lack of awareness from the corporate community, and certainly a lack of adoption. Being purely an interbank instrument, there wasn't a product. The BPO isn't a product. So there's nothing for the banks to sell to their corporates. They had to build a product which used a BPO to manage the risk and finance and settlement relationship between one bank and another. So in this model, it's what's known as a four-corner model. The seller works with their bank, the buyer works with their banks, four parties. The BPO sat purely between the two banks. The relationship between the buyer's bank and the buyer, and the seller's bank and the seller, was subject to an entirely separate negotiation and a separate contract. This approach led to confusion and inconsistency, and ultimately made adoption much more difficult than it ought to have been. URBPO used some terminology which was somewhat alien to the normal terminology we're used to in trade finance and supply chain finance. So let me give you an example. A conditional payment obligation under BPO was known as an established baseline. In terms of positioning, BPO was, at the outset at least, positioned as a supply chain finance enabler. But in reality, once you look at the four-corner model, and once the two banks had sorted out their contracts with their respective corporate customer, the BPO actually resembled a letter of credit. It was much more like a digital LC than a supply chain finance solution. So that positioning made it harder for people to understand how they could use BPO going forward. And finally, technology. The intention was for BPO to be technology agnostic, but in practice it wasn't, because URBPO specified the use of ISO 20022 TSMT type messages to communicate between different systems. Latest technology like blockchain and DLT doesn't really work on that basis. Secondly, URBPO specified the use of a transaction matching application, or a TMA, to match the data electronically. Again, blockchain, DLT, latest technology does not use that approach to match data. At launch, and until BPO was in its final death throes, the only transaction matching application available was, in fact, Swift's TSU, which is the Trade Services Utility. Now, the Trade Services Utility had been built and launched some while earlier than BPO, but had never really gained very much traction. It was, if I'm being a little uncharitable, a solution that nobody wanted to a problem that nobody had. Swift withdrew the TSU a few years ago, and this was really the final nail in the BPO coffin. In light of the problems associated with URBPO and the scale of the changes that would be required, as I mentioned, it was decided that we should simply start from scratch. The rules were first of all entitled Uniform Rules for Digital Trade, but we quickly changed that title to Uniform Rules for Digital Trade Transactions, following feedback from the ICC national committees. And this recognises the fact that it's not the trade that's being digitised, it's the control of the transaction that's being digitised. So we still have physical goods going from A to B on a vessel or on an aeroplane or on a train. But instead of having paper documents evidencing the progress of that commercial contract, what we have is electronic records. So it's the digital trade transaction. Before we started drafting, we agreed a few key principles. The first one of which was the rules must extend into the corporate space. Secondly, we wanted to ensure that the buyer and the seller were at the centre of the transaction, rather than putting banks at the centre of the transaction. Of course, we wanted to allow for the inclusion of banks, but not just banks, also non-bank financial institutions, fintechs, investors, and so on. So we wanted to make the rules as all-embracing and inclusive as possible. We felt it was important for the rules to be compliant with MLETR, and we tried to use the same terminology where possible, such as the use of the expression electronic records. We felt it was important that URDTT would not interfere with the underlying commercial contract or replace it. And I'll explain exactly how URDTT avoids doing that a little later on in this video. Probably the only connection with URBPO is the payment obligation, and we wanted to ensure that URDTT included the concept of a payment obligation, but in this case it would be a corporate payment obligation rather than a bank payment obligation. That said, we also wanted to ensure that the rules allowed for the provision of a bank or non-bank financial institution payment undertaking to support the corporate payment obligation. Let me now turn to the purpose and scope of URDTT. URDTT is an overarching set of rules for a trade transaction which is evidenced digitally. I say evidenced, you could say documented, I guess, but even if we use the word documented, we have to bear in mind that that does not mean paper. A document is not synonymous with paper. A document can be an electronic record, and that's what we mean in this case. So as I mentioned a few seconds ago, URDTT does not replace the underlying commercial contract. Where a commercial contract specifies that it is subject to URDTT, then the evidence of the performance of that contract is submitted using electronic records rather than paper documents. One thing the URDTT has in common with other ICC rules, such as Uniform Rules for Collections and UCP for Letters of Credit, is that it supports the concept that banks, including non-banks, deal in documents, not in goods. Now, clearly in the case of URDTT, the documents are electronic records, not paper documents, but the principle is still sound. So to illustrate, where a seller is able to comply with the terms of the DTT by presenting or submitting electronic records which are compliant with the terms of the DTT, then the buyer has an obligation to pay, and that obligation is independent of any underlying contractual dispute that may arise. Exactly the same as a bill of exchange or a letter of credit. So, to give you an example, if the digital trade transaction specifies that electronic records must be presented which show that a consignment of white t-shirts has been shipped, if the seller does submit electronic records which show that white t-shirts have been shipped, then the buyer has an obligation to pay. Their payment obligation becomes unconditional. If it turns out that the consignment doesn't include white t-shirts, it actually includes red t-shirts, they've clearly failed, the seller has clearly failed to fulfill an important condition of the underlying contract. But that does not give the buyer the right to refuse payment. This is an important concept, the idea of autonomy, the autonomous nature of a payment obligation, exactly the same as a bill of exchange. It is important because trade finance providers, bankers and non-bankers who are lending against that receivable, they rely on the instrument being enforceable on a standalone basis. They don't need to concern themselves with potential underlying contractual disputes. Once they have an unconditional, irrevocable payment obligation, traditionally a bill of exchange or a prom note, then they can rely on the fact that that is enforceable. A contractual dispute is not a defence for the buyer, allowing them to refuse to pay an accepted bill of exchange or an unconditional payment obligation. According to Article 1 of URDTT, the rules provide a framework that applies to each party or person that participates in a digital trade transaction. So in that short definition of a digital trade transaction, a couple of other terms have been introduced which also need to be understood. One is principal parties, the other is electronic record. Principal parties is relatively straightforward, I mentioned it already. The seller and the buyer are the principal parties to a digital trade transaction. The concept of an electronic record is relatively simple to grasp, but the rules governing the use of electronic records are somewhat more complex. So for the purposes of this episode, let's just focus on the simple definition. According to Article 2, an electronic record means this is data created, generated, sent, communicated, received or stored by electronic means. So relatively short definition. So to illustrate, a simple email or a Word document or a PDF could be an electronic record for the purposes of this definition. But also structured data emanating from a platform or a marketplace or an ERP system could also be an electronic record. Article 2 goes on to say that an electronic record must be capable of being authenticated as to the apparent identity of the submitter and the apparent source of the data contained in it, and as to whether it has remained complete and unaltered. So that brings episode 1 to a close. At this stage, all I've tried to do is lay the foundations so that everyone has a basic understanding of the scope and purpose of URDTT and is aware of at least the fundamental definitions of some of the terms used. But we'll get into a lot more detail on the articles in subsequent episodes. So, keep well, stay safe, and until the next time, goodbye.